Welcome to our video on understanding the financial world. Today, we are going to explore how traders track their potential gains and risks using what we call a comprehensive overview of payoff mechanics for long and short positions in futures contracts. Before we dive into the deep end, let's start with a simple question. How do you know if a trade is going well? You can think of a payoff chart as a simple financial map or a GPS for your investment. It is a visual tool that shows you exactly how much profit or loss you might make based on where the price of an asset ends up on its expiration date. On this map, we plot the price of the asset along the bottom and your earnings or losses along the side. This helps you see the direct relationship between market prices and your wallet. Now, when we talk specifically about futures, the way you make or lose money is very direct. Imagine a perfectly straight slide at a playground. This is what we call a linear payoff structure. Because the relationship is a straight line, your potential for profit or loss is unlimited. This creates a sense of symmetry where both the buyer and the seller face the same scale of risks and rewards. Let's look at the first type of trader, the buyer. When you agree to buy something at a fixed price in the future, you are taking a long position. Think of this like pre-ordering a new gadget for a set price. Let's say you agree to buy an asset for 100 rupees. If the price in the market climbs to 150 rupees, by the time your contract ends, you are in a great spot. You buy it for the agreed 100 and could sell it immediately for 150. Giving you a profit of 50 rupees. However, if the price falls to 70 rupees, you still must buy it for 100, which means you effectively lose 30 rupees compared to the market price. To visualize this on a graph, we use two main lines. The horizontal line or the x-axis represents the market price. This line only moves to the right because a price cannot drop below zero. The vertical line or the y-axis shows your profit and loss. We call the middle horizontal line the zero line. Anything above this line is a profit and anything below it is a loss. We can see this clearly if we look at a table of numbers. If you are long at 100 rupees and the market price drops to 50, you have a minus 50 payoff. If it sits at 80, you have a minus 20 payoff. At exactly 100, you haven't made or lost anything, which is your break-even point. As the price rises to 120 or 150, your profit grows to 20 or 50 rupees respectively. When we put these points on a chart, it forms a rising line. This is the visual representation of linear profit accumulation. You can see a red zone where the price is lower than your contract price, indicating a loss, and a green zone that grows larger as the market price exceeds your contract price. This simple line tells you everything you need to know about being a buyer. But trading is a two-way street. For every buyer who wants the price to go up, there must be a seller who thinks differently. This is known as the zero-sum nature of the market. When you take the seller's side, you are in a short position. In this scenario, your profits and losses are the exact mirror image of the buyers. If the buyer is losing money, the seller is making that exact same amount. If we look at the seller's table for a contract at 100 rupees, the numbers flip. If the price falls to 50, the seller actually makes a profit of 50 rupees. If the price stays at 80, the seller makes 20. Again, at 100, the payoff is zero. But if the price rises to 130 or 150, the seller now faces a loss of 30 or 50 rupees. To wrap things up, let's visualize this short strategy in action. Imagine the market price falls to 60. Because you agreed to sell at 100, you can buy from the market at 60 and fulfill your deal at 100, pocketing a profit of 40 rupees. On a chart, this appears as a downward sloping line. It reinforces the golden rule for sellers. Short positions profit when prices fall and lose when prices rise. Understanding these simple charts is your first major step in mastering the mechanics of the futures market.